How is equity ownership partitioned? Well, as we know, a company issues, or you can think of it as creates shares. Okay. So those shares represent some participation in the business. And in exchange for participation in the business, investors will give uh, capital, and it's usually in the form of cash. Okay. So that's like those are the two parts of the transaction: issuing the shares to the investor and the investor giving the company cash. Okay. And so we've seen that again since chapter 2. And the shares represent some fractional ownership in the business. So the different forms that we see in are common stock. We're going to talk about this preferred stock. I think we've mentioned it, but we'll just review. RSUs, so this is restricted stock units. This is basically compensation to employees. It's given in the form of, now it's much more common um, than stock options. Stock options were kind of like how it was done maybe 20 years ago, but now RSUs are kind of the more common way that employees who work for a company, instead of giving them cash compensation, the company's giving them stock. This stock-based compensation is a way to try to mitigate this principal agent problem, right? By making the agent, who's the employee, also a principal, meaning an owner in the business, you're trying to create a alignment of incentive. Usually the company will not give them all the shares up front. There's a vesting schedule, usually over 4 years. So you have to stay to get all the shares. And they keep giving you more. Every year they'll give you a little more to try to keep you there for longer. It's a way to conserve the company's cash too. The company, oftentimes, especially for startups, okay? You can think about Mark Zuckerberg. Who's seen that movie, Social Network? No, it's really good, okay? At the beginning, when they first start, what is the only thing he has to offer his buddies in the dorm to join the company? Equity, right? He can only offer them equity because the company has no cash, right? So in order to get his buddies to work for him, he gave them some equity in the company, okay? Because literally he had zero cash. So it wasn't even about conserving the little cash. He just didn't have any. Okay. So yes, especially for startups when cash is very scarce and there's many uses for the cash, um, you're gonna try to conserve that cash for some entity that like uh, whoever will take the stock, you'll give it to compensate at the beginning. Okay. Because that currency you can create out of thin air. You can't create cash out of thin air. Okay. So like for Facebook, they maybe needed servers, right? The server store is not going to take Facebook stock, right? They're going to only take cash. So that cash that they have, they want to conserve for those purposes. Okay, but the employees, again, the employees also benefit because if the company does well, they're going to make a lot. There's a famous story of the graffiti artist who made the first mural at Facebook's like first headquarters. Does anyone know about this? David Cho. David Cho is like this very like at the time I don't think he was like super famous, but he's like an artist basically. And at Facebook's first office in Palo Alto, they wanted some art, so they paid him, and they're like, "We'll either give you $10,000 cash or stock in Facebook." And I've listened to some podcasts. He's a very interesting guy, but he's basically he didn't have the foresight. He's just like, I'm a degenerate gambler. Okay, he's like a gambling gambler. So he's like, I'll take the stock. Okay, and that stock turned out to be worth like $100+ million because this was like so early in Facebook's life. Um, so it paid off. His gambling paid off. Um, but for if Facebook knew they were going to be successful, they would have been better off paying him $10,000 of cash, right? But again, when there's a lot of uncertainty in the business and it's first starting out, uh, it's probably a good trade to give stock up because most companies fail. So if you can get that graffiti art you know, for these shares, maybe you got it for free because the company goes to zero eventually, okay, which is much more common. Um, but again, if it does really well, you're going to do well too. Okay, so everyone good on this? Like common stock, there's also different classes. I think we've talked about this. You can have, and we'll talk about in the next slide the different rights that are available to the shareholders. So they can be differentiated, but these are kind of the major types of stock that are issued. Now, you can see in this diagram here, we have three concentric circles. Okay, and the way that the stock is organized is that on this outer one, this is the total amount of stock that's authorized. Okay, so when you first incorporate your company, you're going to say there's 10 million shares that are authorized to be issued. Okay, it's the total maximum number. Okay, the next one here is how many you actually issue. So if you started off with 10 million authorized, maybe you're going to only issue a million to start with and distribute that amongst your shareholders. So if there were a million, if there were 10 million authorized, 1 million issued, okay? Let's say you had 150,000 shares. What percent of the company do you own? Assuming they're all like kind of uh, pro rata, meaning divided up equally. What percent of the company will you own if you had 150,000? Is it going to be 150,000 divided by 10 million or 1 million? The issued is what really, this authorized is a total hypothetical number. It's arbitrary. What really matters is the issued. And really what really matters is the outstanding. And how does something go from issued to outstanding? Because the company can buy back its own stock and cancel shares that they've already issued. Okay, so if they issued a million and they bought back 100,000, there's only 900,000 that are issued and outstanding because the 100,000 were kind of bought back by the company and taken out of circulation amongst the owners. But yeah, I just know that you can either retain the stock and then have the opportunity to resell it later, which we're actually going to learn about. That's like one of the big parts of the chapter. Or you could just cancel the shares.